we're going to run this is in turn, each person is going to say a few words about themselves, and then Marcel will give a short presentation, and then we'll also go into some fixed questions, and we'll take it from there. So, Marcel, a bit about yourself.
Okay. Good morning. My name is Marcel Brinkman. I'm a partner at McKinsey and part of the oil and gas practice, where I lead the oilfield service and equipment service line. And I must admit that my MBA is also from another school. I went to Gjerdseth.
Oh, hi, I'm Julio. So I'm a strategy manager at Statoil. So I work with what we call the Development and Production International Unit. And I'm proof of the global nature of the industry, because I'm from Brazil, based in London, and working for the Norwegians. I've been with Statoil since 2009. And before that, I used to work as a consultant. I've been with Accenture for 8 years, starting in Brazil. Have a lot of experience with national oil companies, so I've spent quite a few years with Petroleum before moving to the UK, and then working with national oil companies in the Middle East, before joining another national company in Norway. So that's me.
Thank you, Julio. Ricardo?
I'm Ricardo Barreto, also Brazilian. So I'm the regional director for Gaffney Klein Associates. I recently joined the company. Before that, I was a senior project manager for Wintershall, which is a German oil and gas producing company. And before that, I was with Schlumberger Business Consulting.
Christine?
My name is Ann-Christin Gjerdseth, which I know is not easy to say in every language, so some call me AC. That's probably easier. I work for FMC Technologies, a supplier to the oil companies in offshore oil and gas especially. Been in the industry since the late 80s. Started with Shell, went to the supplier industry, and the challenges in the supplier industry has always been so challenging, so I never went back to an oil company.
Tassos?
Well, thank you. My name is Tassos Vlassopoulos. I'm with GE Oil and Gas. I'm a strategy and marketing director at GE Oil and Gas. I started my career 23 years ago, in the oil industry, working for operators, particularly in the area of new business development and project appraisal. Then I moved to the Boston Consulting Group and joined GE 10 years ago in the power gen sector, and now in the oil and gas business.
Thank you, Tassos. Marcel, would you like to make some opening remarks? Julio, if you want, we can move.
Let's see how we...
A bit of light there, so we're going to get
Good.
going.
Okay, so what I wanted to do is basically set the context in which the industry is operating right now. And when I think of how you maximize the value of the underground resources, the first question is always what is actually the value of underground resources? And as you probably noticed, the oil price has gone down quite significantly over the past couple of weeks and months. Now, why is that? First of all, oil demand is coming down or growing significantly less than people had expected. China is asking for less, and Europe actually has a net decline in oil product demand this year, which is not entirely surprising for the Europeans amongst us, but concerning for the rest of the world. We have a supply glut, so there's a lot of new production coming out of the US, and more importantly, there's less imports heading into the US, and I'll talk about that in a second. And then the third is what I've termed a delayed OPEC reaction. OPEC has not responded in the way that people had expected it to respond, which is by cutting back production to accommodate the US. And as a result, right now we've got prices trading slightly below 80 actually. This is from a week ago. You still see the spot price for Brent heading slightly upwards, but clearly we're in a very different oil price environment than where we were a couple of weeks ago. Now, I wanted to show you this, and I do notice that the land mass is not all that visible on this projector, but the most important thing that is happening is that a lot of the crude flows that traditionally, let's see whether this has, that traditionally have gone from the Atlantic Basin, so from West Africa or Brazil into the US, those flows are disappearing. And they need to find a new home. And the new home for example, Brazilian crude is Northeast Asia. The new home for a lot of the West African crude is also that same region. And crude is traveling more as a result. So you see all kinds of funny impacts. There's a bigger demand for oil tankers. Why is that? The journeys are longer, so you need more capacity. What it also does is that production in the Arab Gulf suddenly has a lot of competition from sources of crude that tended to stay in the Atlantic basin. And as a result of that, they feel that they need to compete for market share. So when you're in Kuwait or when you're in Saudi Arabia, where I was yesterday, you hear people concerned about maintaining their market share and their relevance in the global oil market. Now, why am I talking about this? Because I think that this is not necessarily disappearing. The price levels that we are now seeing are a lot closer to the economic levels, and I don't think there's any chance of oil bumping back up to the levels where we were in June, for example. So companies have three challenges. First of all, project economics. With a lower oil price, obviously the profitability of projects comes down. Does that mean that they become uneconomic? I personally don't think that the oil and gas industry is becoming uneconomic, but I think that marginal projects are challenged, and I'll talk a bit about that. The second is company cash flow, and this is a purely financial issue. Companies have overextended themselves in the past couple of years, and they need to readjust to the new realities, and I'll talk a bit about that. And then if we look at different resource type, we will see adjustments, and we will see an impact, and I think with both FMC and GE Oil and Gas here, we can talk quite a bit about offshore, but I'd also like to talk a bit about what's happening in US light tight oil, where we are also seeing some changes. So this is the oil cost curve, and for those who are not familiar with the concept, basically you have global production on the horizontal axis, and this is a 2025 production forecast that ends at 110 million barrels per day, and then you have the cost of oil. You have the dark blue area, which indicates technical cost, and then the light blue area, which is basically government take. Now, there's a couple of things to highlight. All of this, on average, is economical at $80 per barrel, or $75 per barrel, where we are today, on average. However, within each of these categories, you have marginal fields that are significantly more expensive, and I'll show that for the US in detail. You will see that these sources compete with each other, and that is US light tight oil, oil sands, and ultra deep and deep water production. And it's not that they compete with each other on a day-to-day basis, but they compete with the dollars of the investors in this industry, and therefore they will have to make a choice about where they want to invest. Now, I spoke a bit about the operating the cash flow constraint, and what we've done is on this chart is we've taken a look at a number of the larger companies, basically the ones that are driving a lot of the offshore development, and we looked at how they are spending their cash flow, operating cash flow. And in 2005, of the 100% of operating cash flow that they had, about 37% went into capital expenditure, 40% went into dividends and buybacks, and then the rest they used to strengthen their balance sheet. In 2013, 86% was spent on capital expenditure. They maintained, roughly speaking, their dividend and buyback policy, but then they had to borrow. Now, clearly, you don't want this as an investor. If you invest in BP or Shell or any of the other ones, you're basically investing in a company that is, first of all, having lower returns. Second of all, is gearing up its balance sheet to maintain its capital expansion. So institutional investors about a year and a half ago started to complain about this, and most companies have since then reined in their capex spending a bit. Actually, to the extent that capex or capital expenditure for the industry as a whole in the third quarter has actually turned negative. So what you see on this graph is quarterly expenditure by all the companies in the industry that publish their results. We just simply added up those numbers, categorized them, and then looked at what is the 4-quarter rolling average growth rate. And in the third quarter of this year, it went negative by 0.5%. So in the last 4 quarters, we had 0.5% less growth in capital expenditure than in the previous four quarters. Maybe more interestingly, the third quarter of 2013 was 6% lower than the third quarter of 2013. So the industry is contracting in very simple terms. Now, and this is obviously a concern if you are playing in this industry, because we like industries that grow, industries that create more value, and right now we're in an industry that has returns that are very close to the cost of capital, and also is starting to contract from a capital expenditure perspective. Now, what is happening in individual basins? If we look in the US, a similar cost curve, but now for the US and based on the number of rigs, individual basins, quite a few of them, Eagle Ford or the Bakken or different tiers of the same basins are still economical. However, there's a number of basins that are marginal from an economic perspective, and they will probably start to cut back activity. And we think that about 100 less rigs could, we could see 100 less rigs active in the market within 6 to 12 months, just by virtue of the fact that they're operating in uneconomical areas. And if you look at the totally active light tight oil rigs, that could be a 10 to 15% activity reduction, and that is obviously slightly concerning. Then, if we look at what's happening in offshore right now, and this is something that you will have seen in the newspapers as well, if you saw the Seadrill results announcement yesterday. Right now, we are seeing less and less offshore drilling contracts being signed each year. We had 55 of those contracts in 2012, we had 45 of those contracts in 2013, and we had only 20 of those contracts up until September this year. So there's less new activity in the deep water space. At the same time, we are seeing some postponement in activities in the oil sense as well. And this is both the result of the developments in the industry, but it also is clearly something that the industry needs to address. So what do we see most of the players do right now? First of all, they're asking themselves a portfolio question. Which activities do I want to have in the portfolio that can actually withstand a prolonged period of lower prices? And I think that a lot of people in the industry are preparing for the price level that we are currently seeing. How can you reduce your operational cost to boost profitability in a period that is affected by lower prices? And some companies have gone pretty far already in terms of slashing their costs. And in particular, if you look at Statoil, without wanting to put Julio on the spot, but Statoil has been leading the industry by slashing its operational expenditures, at least more than others. Then in the investment spaces, how do you rebalance your cash flow statement? Because I'm a firm believer in the statement that most of the projects are still economic, but the companies just don't have the cash flow, the liquidity to spend on them. So how do you rebalance your projects over time? And how do you make sure that they are more economic under lower oil prices? And it basically boils down to the question which projects can actually get delayed. And then I think an interesting question for the investment bankers is what will happen to the balance sheets of the oil and gas companies? Can they sustain their dividends? Seadrill, which is not an oil and gas company, but a supplier to the industry, decided that it could not sustain its dividends, slashed it to zero, and the share price dropped by more than 20% in one day. For me, an interesting question is which oil and gas company is going to be the first one to slash its dividend, and what will be the response in the market. So I hope that this is a good context to kick us off. And Tim, back to you.
Additional question, please. Name and affiliation when you ask a question.
It's Selvig from FMC. Yes, your analysis is correct, and I think we all see it. What puzzles me is that everyone is thinking the same. Everyone talk about growth in the same time period. Everyone talk about capital efficiency in the same period. We know that the investment horizon of the project are 30, 40 years. No one knows the commodity prices in that time span. I'm so puzzled that we as an industry, over and over again, move as one herd. I mean, of course, that drives the cyclic nature of the business. Mm-hmm. So, are we? How can we change that? How can we sort of be more diversified in the way we think, so that we can have a sustainable long-term perspective of the industry, mm-hmm. and be less cyclic?
Mm-hmm. Yeah. So I think one of the key issues that we are seeing today, and also what we saw in 2008, is the simple reality that companies are running out of cash. And I personally don't think that. Well, I'll tell you a discussion that I had with the head of portfolio, long-term portfolio planning at one of the majors a few weeks back, and he basically told me he's got two prices: an FID price, so a firm investment decision price, at which every project needs to be economical, and for him that is around 80, and then there's the budget price, at which he makes his budget for next year. And then the 2 or 3 years thereafter. And he basically says the one price is 80, the other price they always had was 100. And that basically means that you can invest in projects at current price levels, by and large, but he cannot pay for them because he doesn't have the cash flow to pay for them. And I think the cyclical nature of the industry is to a very large extent a function of the amount of cash that is available. And if you're spending as much cash on capital expenditure as the industry is doing right now, you basically don't have a choice but to cut back. That being said, I do see quite a lot of long-term thinkers in the upstream oil and gas companies. I see a large debate about which resource types they should invest in, whether it's unconventional, whether it's deep water, whether it's traditional onshore. I also see an increasing amount of debate around what is long-term energy demand, and are we going to see so much energy efficiency that demand growth will actually dissipate from the industry? So people are quite thoughtful about the future. I think they're just events are being taken over by a lack of cash at this stage.
Thank you. Thank you. I'm Tatiana Mitrova, Energy Research Institute of the Russian Academy of Sciences. So first of all, thank you for a very interesting presentation. I have a question concerning capital expenditures, which rose like 3 times. What is the explanation of this fantastic increase? And you remember in 2006, actually, all the capital costs started to grow very fast, with oil prices going up, steel prices, all commodities prices. Yeah. So they like doubled in a couple of years. Do you foresee now, when the commodity cycle went down, some decrease in the capital costs, which could actually lower these break-even costs for many projects?
Yeah. Now, I think that's a fascinating question, and if we look at the price inflation in the industry, it depends a bit on which area you look at and which data source you take, but prices have increased by 5 to 10% over the past 4 to 5 years, and that's obviously quite a lot. And fortunately for the supply industry, the oil price has risen more, so they got away with a lot of those cost increases. If you think about what was behind those cost increases, you need to distinguish between the various categories. So if you take a large capital project, let's say an offshore project, drilling costs are between, let's say, 25 and 40% of the total cost. If you just look at the drilling rig rates, how much they've gone up for an ultra-deepwater drill ship, they touched on $700,000 per day. They're now back to the low 500s. Why was that? There was a shortage in the market. There wasn't enough capacity, and drilling companies could get away with those higher costs. At the same time, the cost of building one of those vessels has gone up as well. But they've now come back down to a level where you basically justify the cash cost and a tiny return rather than the super returns that the drilling companies were earning. If you think about, I think, let's take something like subsea trees to put it more in the space of FMC and GE oil and gas. I think that there we've seen a lot of cost increases due to the complexity. So subsea trees have grown tremendously in complexity because of the fact that they had to withstand higher pressure, higher temperature. Therefore, there was more engineering hours added to it and more complex valves that needed to be applied, etc. So you see all of that add to complexity. And maybe a factor that I've had quite a lot of debates about recently is the fact that the industry hasn't really learned how to standardize or modularize, and that every company, whether it's a Statoil or a Total or a BP, has its own subsea tree design that it then imposes on the providers of those types of systems. I think we'll see the trend reverse.
Well, I think I'm not going to answer this question because the 4 questions you're going to be asking will be exactly on this particular point. So I will not say
another question. What are the management interventions that operators can make to significantly improve efficiency? Ann-Christin?
I agree with you. The oil and gas industry has been fantastic. It's creating high returns for a long time. And now with this oil price going down and the costs really going up, we see them becoming more or less like other industries. So the question on standardization is a hot one. But I'd like to say that one way of maximizing the value of the reservoir, of what the underground resources, is to find a good way of cost reduction, not only on the capex side, which you talked about, the investment of the field, the projects. The way we organize our business is that you build these huge projects on the field development side, but there's also the operational cost of maintaining the field and making sure that you can increase your oil recovery from the reservoir itself. And I think what we as an industry and as a supplier industry, our responsibility is to come up with the good concepts, both for the initial investments and the capex side, but also how to maintain and recover more resources with getting more out of your reservoir. And even though subsea, which I represent, is only about 9 to 15% of the capex investment, it can drive how you actually choose to develop the field in total. But that needs a different kind of involvement early when you discover the resources. And I think the traditional work model that you're working to today, the business model, is very much for the oil company to sit on their concepts for very long, and you don't get the early involvement from a very competent supplier industry who can help develop the right concepts that could be or could drive a total different way of developing a field. And coming back to your thing on standardization, I want to say that the costs are really built up by three components. Yes, getting a volume of what you make for the oil companies can drive down costs. Standardization could take as much as 30% of your cost base out if you manage to standardize across oil companies and use supplier standards as opposed to each company standard. And then I would say that the work processes that you can collaborate with your partner in a different way can take some 10, 15, 20% out of your cost base. But I think what gets forgotten in this phase we're in now, where the oil price goes down and everybody's panicking on the cost, is that technology breakthroughs do represent maybe half of your cost base. We see that if we could introduce new technology, we recently made a good collaboration with Petrobras in Brazil, who are still willing to invest in technology, where we took the robotic concept all the way subsea, halving the size of a manifold, which means you drive significantly the costs down. So innovating the concepts could really bring your breakthrough, your break-even price down. But it does take a different collaboration that has to be founded on trust and a new way of collaborating between operators and the supplier industry.
Julio.
So if I may add on the efficiency or cost reduction point, and especially in the capex one, just maybe going back to your first point about portfolio. For me, that is one of the key points about where things can go right or wrong. So if companies don't have the discipline, the focus, and if they don't say no to projects that are sub-economical, you're never going to be able to do much about your capex going forward or your efficiency going forward. And the prices that we see today, so $77.5, $80 a barrel, that's not the price that we should be concerned with when we sanction a project. We need to be concerned with the price that we're going to see 10 years from now. Those are the prices that are going to influence the projects that are going to be sanctioned today. So don't underestimate the portfolio thing, because building robustness on the portfolio is the key thing for companies to become more efficient. Going down to the more management interventions or the working processes that we can see to improve efficiency. Just building up on what Ann-Christin was saying, on the design phase, the idea of building it right, designing it right the first time, so not having those endless design rounds where, well, let's adjust this and that, and well, we got it wrong, then we send the suppliers and the suppliers send back to us. So how can we get it right the first time, and how can we make a lean concept as well? So you have all the redundancies. We are used to operating in a harsh environment, building very resilient facilities, but we need all of that everywhere. Or how can we actually trim down? How can we start from a different mentality, from a more lean perspective, and then build from scratch, build something not similar to what we have done before, but fit for purpose. And also on the design part, how can we be lean, but at the same time flexible enough to allow for the uncertainty in the market? Can we do a concept based on different phases? Can we build on a smaller scale than we would need, and then we add scale as needed afterwards? That would allow for the uncertainty on the market, on the oil price. And also, as you start operating the field, you gain more information, you gain more knowledge about the reservoir, about the subsurface, and then you improve after that. And then I think my last point on this is about integrated planning. So not only on the design phase, not only early on, but also for the operations team. So how can you optimize your supply chain, your logistics? And that's especially important for the onshore operations, for unconventionals. It's all down to the margin. So being able to run your logistics service very efficiently will make the difference between having a break-even price of $40 or $70. So being able to bring the trucks with water or the other components, or the drilling rigs, and moving the crews around, that it makes a lot of difference, especially when you have to drill hundreds of wells, perhaps every month. So.
Thank you, Julio. Right, so what are your views? What management interventions? Sir, number one, number two. And I have another speaker next.
Hi, Bob Spence, Capital Project Partners. One of the suggestions that I would make in terms of what the operators can do is let this generation of managers retire without calling them back. I've been working with project teams and mega projects for past 10 years or so, and I have never met a more miserable bunch of spoiled brats. These are very well-paid people who are very fixed in their views about how to conduct mega projects. And I think, to the gentleman's point earlier, there's required a change of thinking. The operators, the IOCs, have invested very little comparatively in the next generation. And they need new people, new blood, and new ideas about how to get mega projects done.
Well,
and editorial.
Are you going to get a response from Tassos?
well, actually, I agree with you. I think you make a very good comment. Very recently, the head, an executive vice president for a big corporatist, NOC, said that people who are at the age of 40, 38, 42, need to unlearn the way things, whatever they know about managing projects, and effectively shift their mind, in different ways of doing it. And I think there are a number of questions we will come to it, and I think we're going to be regurgitating exactly the same story. Are we bringing lessons and learnings from other industries into the oil industry? And I don't think we are doing it enough. And I will wait for the question for me to answer it. But I agree that we need to change the way we're doing things. Now, whether we should fire them, it's a different question.
Faraz Ahmed, GE Oil and Gas. So on a similar vein, I think everyone understands that squeezing the supply chain or doing price negotiations is not going to fix the problem. What we really need is a radically different way of working, as has been elaborated. Just on the point that Tassos was making on learnings from the industries, obviously GE's got the advantage of working in a whole host of other industrial sectors. But if you compare it to aviation or power generation or wherever else, I'm always shocked at the level of customization as well as the lack of collaboration with the rest of the supply chain. So the level of qualification, the lack of a certifying authority that everyone trusts, if we compare it to, say, an aviation where Airbus or Boeing or whoever would give a functional spec to a Rolls-Royce or GE, And there's no dictatorial or prescription of whether it should be a titanium blade or a steel blade. It's given to them and they have the responsibility. That maturity in thinking of, as Ann-Christin was saying, on collaboration on the early concept, I'm not seeing that to the same extent in oil and gas. And I think it's going to require a radically different way of thinking of how to deal with mega projects, a different way of how to manage them in phases, as well as a whole way of working together with the wide supply chain and way of thinking.
Any responses from the audience to that remark? What do people think? Is that provocative? Right, okay. You sir first. Yeah. There's a microphone coming to you from people.
Hi, my name is Mohammed Saqib. I'm a student at LBS, and I come from an energy background. Just in response to your question you asked, I think the fundamental problem lies with the uncertainty in the oil and gas, whereby when the projects evolve, you have things change as you progress with the projects in terms of the subsurface. And when you talk about mega projects, as things evolve, things change, and that's when you need to customize, and hence the cost rise.
Let's deal with that in this question, right? Because I think there's the next question about the mega projects, right?
I'll frame the next question for you.
Because we're going to be taking exactly something.
How can national and international oil companies continue to develop and operate very large projects in light of the falling oil price?
Well, obviously, this is, you're going back to all the points that have been made so far, right? The project size and complexity has increased, and the skills have not really matched that change in the complexity. I think that at some point there will be some kind of equilibrium on this particular point. On the point that the oil industry is so special that requires, a bespoke approach, I disagree with you. And I'll explain what I mean by that. The oil industry for all of us is very special because we are in the oil industry. But we also have a great incentive to see the oil industry continuing, and performing well and doing the projects that they are in the pipeline to be done. If we continue approaching it in the same way that has been approached for many years, it's not going to happen, right? Statoil, for instance, has taken initiatives to cut, the costs. Many other companies, Total, wants to do the same. I think everybody's waking up to the whole sort of issue. I'll give an example. Everybody wants to standardize in the oil industry, but they want to standardize to their own standard. Okay? So the operators want to standardize to their own standard. An example, we provide, gas turbines ourselves for many different applications. A gas turbine for a compressor application requires about 5,500 hours of engineering time. For the same gas turbine, for an oil and gas application, requires 35,000 engineering hours. This is amazing. Now, we provided this information to Statoil, during the ONS conference, okay? This has gone around and effectively has surfaced a number of questions why this is happening. What Faraz was saying earlier on about the aviation business. In the aviation business, the airline is buying an aircraft, okay? The aircraft manufacturer is actually defining what specifications they need for the engine. The OEM, the engine OEM, produces an engine based on meeting certain criteria and getting a certification from the Federal Aviation Agency. Now, what we need to do here in order to take costs out and deal with the mega projects is to effectively reduce the amount of qualification. Clearly, we have to do that. Okay, design one, build many. That's an higher approach. To use a McKinsey phrase, design to value, we call it fast works ourselves. Okay, this is effectively working with our customers and trying small pilots and then scale them up, learning with our customers. And obviously, we would like to see the operators having a wider sort of collaboration, especially in some activities. If you do an IMR project in the North Sea, there are a number of vessels around, there are a number of operators. There shouldn't be a reason why the operators cannot really coordinate in actually doing a project, at the same time. There should be some kind of sharing of information between the JV, the operator, and the OEM. Currently, it's all reactive. It should be in the future, it should allow, let's say, predictive use of the data and the flow. If there is a problem, then they call us, they say, switch on and see what happens to the equipment. I'll fix the problem, turn off now, and we will, you know, thank you very much. Well, that's not the case. You know, I think in the aviation business, if an aircraft is flying, the equipment manufacturer can actually see that. And finally, I think what we see here is if the industry doesn't approach the cost structure and the way we do the business, there will be another round of consolidation that we saw in the 1990s when the oil price was actually low and they had the creation of the mega, you know, super majors.
Yeah.
Okay, before we give Julio his rightful time, so Marcel, did you want to say something as well?
No.
Okay, all right.
The one thing that strikes me, hearing for us talk about the aviation industry, the aviation industry has only two major suppliers, Airbus and Boeing. If we look at the oil and gas industry, it's starting to become quite a bit like that because we've seen Halliburton and Baker merge and we now have only two service companies. If I look at the subsea tree space, I only see 4 companies. So are we basically pleading for further consolidation of the service and the equipment sector so that they can impose their standards on the oil and gas companies?
That's a question.
Well,
That's a good.
and then that's my point, because the alternative of few suppliers imposing the standards on the companies is the companies sitting together and designing the standards. But then I think that part of the reluctance for the companies themselves to sit together and agree on anything is that can you imagine the whole bunch of oil companies sitting together and discussing anything that would scare the hell out of the regulators. Then everybody would start to think about collusion on the oil markets and so on. That is probably one of the historical reasons why the industry, while the companies as a whole, have been reluctant to agree or to tackle some of the industry-wide challenge. They're very good at partnering up and tackling challenges on a project-by-project basis. And then the problem with that is that each specific project becomes a unique project in itself. So tackling industry-wide issues, and this point about standardization, maybe the point about automation and the increased use of data and digitization to actually manage better the facilities. It's something that could be tackled if the companies sat together, but chances that this happen are slim for historical reasons.
Ann-Christin?
No, I think there's kind of 2 issues. One is to bring new technology to this industry, who's normally been learning from itself rather than learning from others. So that takes a different kind of leadership to go to other industries and bring new technology to this space, because obviously it used to be very special. But a lot of what we do now, there are segments of what we do where we truly can learn from other industries. You mentioned aviation, we can mention many other industries as well. So I just want to make the differentiation between when we can take technology from other industries into this industry, which takes a different leadership. I also want to say that there's no point in standardizing on the wrong solution. And subsea, which I represent, is still a young industry. The tree that we have today is not ready for standardization because we're standardizing on the wrong cost base. You need to find the optimal design before you start mass producing the standard solution. So I really want to not take away the technology I mentioned of product improvement before you standardize. I know a compressor have gone through a lot of changes. We've gone to a more mature stage, and then you can go into a volume thinking. So there's still this balance. We have the nuance between standardization and technology breakthrough. We don't even have a standard bolt in this industry. One single bolt. We still worry about the material requirements and inspection requirements for that bolt. So certainly we can standardize on components, but we're not ready to standardize on a system level. That's the point.
That's just a very brief response before I take it out. Julio. Did you want to?
Okay. I mean, 2 points here, and nobody wants to talk about collusion here. We're not talking about this, but collaboration can happen in many different ways. In fact, collaboration is happening in the power generation business. It happens through service contracts. It happens already in the oil and gas business. the IPM model is actually a form of collaboration. Okay, that's clearly we believe in competitive markets, and we are very happy to be a strong competitor ourselves. So we want our customers to be successful, but we want to serve our customers. But nobody wants to see the collusion. As far as the point that Marcel was making earlier on the consolidation, who's to say? I can't really speculate. We'll see what happens. My personal take is that having Schlumberger and Halliburton as the two key service companies is an interesting development. Only two is probably a small number.
Yes, a bit back to my earlier comment. Sorry about that. Selvig from FMC. It's a bit back to my earlier comment on everything thinking the same, a very cyclic industry. Now, yes, obviously this is a race for cash and short-term thinking, and that is driven by dividend policy and shortage of cash. And we see that across the majors. But everyone is thinking the same, and so that's we discussed that. But when it comes to how to solve this efficiency issue, cost rising, price falling, it seems like that the solution is from the customer side seen to be competitive bidding, more competitive bidding. More, and the supplying industry should be more concerned about prices, lower margins. And again, we see that across the industry. Statoil is thinking that way, Total is thinking that way, Shell is thinking that way, BP is thinking that way. Everyone is thinking that way. And was also mentioned earlier in the keynote speech by Schlumberger management that it seems like the solution to this is more competitive bidding. While we now talk about collaboration in this panel, we talk about trust, we talk about reframing the relationship between the customer and supplier, which for me is a quite significant contradiction. So we have a customer side that thinks that this will be solved by more competitive bidding, squeezing the price or the cost down of the supply chain, while the supplying industry talk about collaboration, technology innovation, partnering, more exclusive relationships. So I see a tremendous dilemma here. How do we tackle this challenge that we now are facing, all of us?
Okay, someone from the audience want to respond to that? Do you want to ask? Right, you want to respond? Okay, and then
I just somewhat, Faraz Ahmad, GE Oil and Gas. I just somewhat respond to that because when my interactions with the oil companies, everyone's trying to get to the same thing of reducing cost and reducing risk. But the perception of the way to get that is quite different. So the oil companies will tell the supply chain, you're not qualifying enough because it's a bespoke project, want to reduce the risk. From the supply chain point of view, it's a difference that actually the more qualifications you're adding, the more tweaks we're adding to the design, and therefore the more risk and cost you're adding to it. So they're both trying to reach the same thing, in my opinion, but the perception is the way to get is quite different. Whereas, just coming as an example to power gen or aviation, I think they've learned as well that the best validation that you can have is field-proven experience. So they will only use a component or a standard, or whatever it may be, that's been tried and tested and had a certain number of hours that's been used. So I think there's a very different mentality between the operator's engineering team and the supply chain engineering team of how to get there. One, which is about we can reduce risk through bespoke engineering and customization, as well as the subsurface uncertainty, while the supply chain feels that actually you can standardize within a certain range, and why introduce new risk and new complexity just to fit the qualification of a specific project.
Hi, my name is Tejal. I am a student at Harvard Business School. I have two questions regarding the standardization that we are talking about. One is, you have to also have standardization, I think, within an organization and then across organizations. So within the organization, I think more often than not, you have in big companies, like different parts of the organization talking to the same supplier and sourcing services and components for their projects. So do you see any opportunity in terms of consolidating those supply chains within the organization and basically getting the synergies and sharing that knowledge across the organization, that we're using one type of compressor, one type of components in one project, and that has worked well, and basically sharing that knowledge across the organization so that next time when you're doing a similar project, you don't reinvent the wheel. So that is first. And the second one is, I think what you talked about, Ann-Christin, that we need to bring new technologies to the industry. At the same time, I feel like there is a lot of learning that can be applied. So if, for example, if you design a new subsea component that is kind of based on what you see in the project of one major, but that can be applicable to, that's kind of elevating the standard of the component and bringing new technology in. And kind of, you can essentially supply that throughout the industry and raise the standard altogether. But then do you see any IP issues, and how do you basically balance those two? So I guess the two questions is, one is like, how do you ensure knowledge sharing across the organization, within the organization? And second is...
Who wants to field this? Right, Ricardo?
Yeah, maybe the first part of it I would like to address with some examples, right, that are already happening. And I pick one. I mean, there's no single FPSO that is equal to another, right? So every FPSO is particular in itself, and they come with different prices, okay? So to the extent that I would speak about an example of Petrobras, I mean, they used to put a bid on everything because they want to put competitors across one another, but they want to these FPSOs to be built under against the standards of Petrobras, okay? It turns out that nobody shows up to the tender, just one supplier shows up and offers $2.2 billion as a cost, okay? And then so they call off the tender and they say, okay, what should we do? Okay, we should open more the standards and then call off for more. We want to have more suppliers. Eventually they sit with they agreed on a $1.2 billion FPSO. So it was $1 billion, 1.2. So it was a $1 billion difference from a highly standardized or highly designed according to Petrobras standards to one that was open standards, if you wish. So to accommodate that, what Petrobras is willing to do, and they're trying to do that, is to do what they call replicant FPSO designs. So this basically, you try to make it as more open as possible, if you wish. Okay, and then you say, well, my oil specifications will be around these parameters so that you could have some basic designs that look like the same. And these replicants FPSO should be built to the specs, which are more broad, okay? And this is a way of trying to, from one project to another, to cross knowledge, to bring the knowledge across different projects, which every project in itself, it's a different company. So that's why that's a major problem for these companies to make knowledge sharing from one project to the other. So having this local central functions, if you wish, that say, listen, this will be the standardized model for our FPSO designs for that given type of oil. And then you can try to replicate that. So that's a little bit one example.
Yeah, coming to your question on IP, how do you protect if you share? I just want to say that this it used to be so that this was a very high tech, and you used to innovate everything that you did subsea. And just to give an example, take communication. Communication subsea was extremely difficult back when we started. It was very proprietary. FMC was the first one who invented a protocol, and we protected it. And then we ended up saying, okay, we gave it out as an open standard. And now communication subsea is commodity, Used to be so that heat used to be a big problem subsea. So you had all these patents, protecting your thing. Well, guess what? Electronics have moved on, and the electronics doesn't dissipate heat anymore. So what used to be core, difficult, very hard, is now off the shelf, not a problem at all. So I think if you only rely on patenting and thinking, that's not what the supplier industry needs to do. And I think that's gonna, you have to keep moving. If you don't move, the technology that you patented yesterday is obsolete. So keeping moving and keeping moving with clients who understand the value of early involvement, so that you actually select a bit the partnerships and you try to actually do the breakthrough. What the dilemma we see though is that when you have this cost price crunch, technology is just off the radar totally. And I think we're missing out big time on bringing the cost significantly down, 50%.
Okay, I'm going to move on to the third question, but can I ask you, your subconsciousness is just to think about a completely radical, different answer to the question I just posed. I'll just say it again. How can national and international oil companies continue to develop and operate very large projects. I'm not going to ask you to respond to it now, but I feel that the discussion has polarised about one or two features of a very big subject. So if there's time at the end, I'd like to revisit it, because it is fundamental. It is managerial, as well as the things that we've been discussing here. So I'd like you to come to me when I wind up the fourth question with responses to that question again, at a much higher level, much more strategic. Okay, the third question. What should the new national oil companies, the new ones, do to accelerate their learning curve on very large projects?
I think we clearly have quite a few NOCs operating across the planet. Some of them have been gifted by resources that have continued to produce for a long time. For example, Saudi Arabia. We are now also seeing quite a few new ones really coming into being, and I suspect you're mostly thinking about, let's say, East Africa gas and those types of development. Most of those countries are really struggling to develop the resources, and we do quite a bit of work in those regions nowadays. And the basic problem is the lack of knowledge, the lack of infrastructure, the lack of basic facilities in order to get the industry going. Now, the traditional answer to this question has been you get into bed with an IOC. A BP, a Shell, one of those companies, and you let them develop the resource. Increasingly, you see countries basically say, okay, we want to take more ownership, we're not willing to share as much of the wealth with the large international oil and gas companies, and we are either going to found our own NOC, which, for example, Angola is doing with Sonangol as one example, or we are going to be a lot more prescriptive in terms of how we are going to do things, putting in place local content regulation, and thereby imposing on the supply chain, because mostly on the supply chain, not on the oil and gas companies, but a much greater degree of presence in those countries. Now, I think this is a big debate, and unfortunately, Petrobras is again the prime example here, because it's one of the few companies that is being burdened by this. Well, I guess that if you look at
conflicting dilemmas.
Yeah. So Petrobras wants to develop the world's biggest offshore basin, I would say, or at least the biggest deepwater and ultra deepwater basin. Has a regulator that basically says, okay, 65% of everything you buy needs to be bought in Brazil, and there's 65% is a simplification, and everything you buy in Brazil is also a simplification, but that's by and large the dilemma. And therefore, they look to their supply chain and basically say, okay, FMC, GE, why are you not building subsea trees in...
We are. We are.
Now, I've seen subsea tree manufacturing facilities, and I've also learned that there is different ways how you can develop subsea trees, because the reality is if you want to have a good forged block of metal, you want to get it from 2 suppliers in Germany, by and large. And I'd be surprised that if you were to get your forged metal in Brazil. But the problem is the industry has certain ways of working, and transferring that all to Brazil is just incredibly costly. And you need a certain production volume. You need to have a certain guarantee for your subsea production trees before you get that. So you get this big dilemma between what is an effective way of developing your resource and what is best for the development of the economy. And I think that this is playing out in Brazil to a massive extent, and I think that the countries in East Africa are trying to learn from that.
Okay, Tassos, I think you intimated you'd like to say something?
Yeah, I think I'm picking up on the point from that Marcel actually alludes to. The new resource countries need to develop their own countries, right? And in different countries have got different stages of development, right? We all know that. So the industrial policy of the countries needs to be, driven so that it adds value. Now the question then becomes, to what extent all these local content regulations contribute to the escalation of costs. I think there is a number of analyses that show that it has been a contributing factor if you have to localize everywhere, then your costs are going to go up. If you have to meet many different kind of, compliance of local, content regulation, that will lead to costs. So the question then becomes whether you can have some kind of regional hubs, right? Whether countries, and I do not know to what extent this can happen. I'm not a specialist in that particular area. To what extent you can have countries of a western continent or the west part of the continent or eastern part of the continent getting together and saying we want to do this and you guys need to do something different, so that you can effectively bring in local content, share it, the value somehow, but at the same time then put some limits for the future, right? After 15 years you need to open up the market and bring in kind of competition into the market. And there are different kind of strategies countries follow. Brazil is one, Saudi Arabia is another. Nigeria, we got different kind of rules. So it's very difficult sometimes to navigate through that if you are in the supply chain.
Sorry.
We're going already into my topic of
discussion,
but I would like to let you go. But
do you want us to steer back to the original question? Right. So I'll put it to the audience now. Okay?
Yeah, put it to
What should the new national oil companies do to accelerate their learning curve in very large projects? Well, in a minute. Let's see if anyone else wants to put their hand up. Any other? Who would like to try and address that? Think of managerial issues, partnering, which has been mentioned by Marcel. What other things can a national oil company do so they're competent to engage in very large projects? So, yeah.
Thanks. First things first, Bob Spence, sorry. First things first, I would hire the Norwegian PSA to set up a sovereign wealth fund for the NOC, so that the stewardship of the resources passes to an independent body rather than venal short-term politicians. That would be the first thing I'd do.
Okay.
Yeah, can
More questions, right.
Okay.
Anyone else other than you? We'll come back to you. Anyone else want to think of how a national oil company can be skilled enough to run a major project like Mozambique and others? What are your ideas?
Hi, I'm an MBA 2016 first year, and I actually have a background in one of the oil majors before this. So I'd probably take the example of what Petronas is doing in Malaysia. They're actually in every one of the joint ventures that I have seen that they have with every other major in Malaysia, they ensure that they get to know whatever new management practices are being put into place by these organizations, and Petronas actually looks to replicate all of that in each one of their projects. So much so that going forward, they pretty much drive these processes. So for example, one of the things that I've seen moving in the 4 or 5 years of my experience was something as basic as effective risk management. And you can see Petronas developing itself in terms of the way they were earlier taking it from the oil majors, and then they were driving it themselves internally. And similarly, they are also doing something similar on technical efficiency as well. They're doing something similar on technical expertise in-house by bringing people from international majors, by bringing people from EPC companies to build that in-house expertise, which again is kind of industry standard because you're bringing people in who have past experience in these other big oil companies.
Okay, another view? Does anybody here work for the Chinese oil companies? No? Any other views on how you can...
Talking agent over there.
Yeah. I work for oil major as well. I'm not trying to be fancy, but I still believe in the fundamental, communication, sharing knowledge. So I hosted a few events between BP and different oil majors in China, in London. I mean, the Chinese companies now, they have cash, they have technology, they can buy them. But what they don't have is actually experience to manage a huge corporation because they're growing so fast.
and they're trying to expand internationally as well. And what they desperately want to learn is actually how BP or Shell can be, or Exxon, or the big oil majors can be so successful and so sustainable over the years. And I think that is really something, the oil majors can actually, the independent IOCs can really help the national companies.
If I may comment, I think just for the sake of this discussion, it's also interesting to differentiate between the very frontier, countries like East Africa, Mozambique, Tanzania, so they're building a whole industry from scratch. It's not only an oil company, but also the whole the fiscal infrastructure and the industry that the country needs. And some of the Asian companies, for example, that are trying to speed up their learning curve. And I think one interesting example would be looking at making broader partnerships, and I think looking at what Statoil did with BP back in the 90s. Back at when Statoil was still 100% owned by the state, and the company was basically a Norwegian-only focused company, and he wanted to grow international. It partnered up with BP, and the two companies together entered a range of opportunities abroad. And then there's an element of risk sharing as well that's important. Asian companies, by and large, have a preference for getting into projects when most of the risk has been reduced and the project is either ready to be commissioned or is already in production. To be able to properly learn from the development of those projects, from how to work internationally, I think it's important to get earlier together in this kind of partnership. So sharing the risk from the project inception all the way to production.
Any other reaction?
Hi, my name is Yada from Manchester Business School. I have an experience from National Oil and Gas Company in Thailand. What we did is we very focused on education. So from last couple of years, we did we just created the oil and gas school in Thailand. And from that perspective, the National Oil and Gas Company in Thailand, we try to joint venture with large company, and we try to send the competent people to work in that mega projects, try to learn from the big company in order to develop our the national company.
We've gone to the fourth question now, which has been touched upon, but let's do it formally now. How should the newly resource-rich countries optimize the development of local skills and services and attract inward investment?
Yeah, so that's the local content topic. So before going to that, I would like to make define the topic in make two definitions. The one definition is there are what oil economies are, and the local content policies for oil economies. So these are two different aspects of the same discussion. And as an example, I would use Brazil as a non-oil economy. Brazil non-oil. So non-oil economies are economies that don't depend on oil for their budget equilibrium. Okay, and Brazil is an example. And one of the key aspects of the non-oil companies is that fundamentally they have the industrial capacity to build up the supply chain necessary for the oil and gas industry. And just to remember, the oil and gas industry has a very, very long value chain, right? And the statement I would like to make for this non-oil economies is that primarily this is everything about defining where is your comparative advantage. In the case of Brazil, it could be offshore and it could be the subsea, for example. The country might be, by and large, the biggest subsea market and offshore market today, as of today, and going forward as well. So the one aspect that people, when doing local content policies, should consider is involving the supply chain, not simply putting the tag, putting the toll on the operators, which is happened to be the case in Brazil today. All right? So you're not involving your supply chain. So on the policymaker side in Brazil, they have to ask themselves, I mean, take the comparative advantage of subsea. I mean, by being the biggest subsea market, you have the economies of scale eventually to become a global supplier of subsea tree systems or subsea items to other countries, okay? So that would be a different way of putting local content to perspective in a way that you would that you make a win-win situation. It makes good for the supply chain to be there. It makes also good for the country because you're inserting the supply chain into the global industry, which is the case of the automotive industry, right? The automotive industry works up on a global supply chain basis. For oil economies, I think the statement I would like to make is that this is much more about building their human resources capabilities, which some of the examples that people open up here showed us, because these countries fundamentally, they lack the industrial capacity, as Julio mentioned, to do the industrial engineering that you do. But the fundamental thing, and here I picked the example of Angola that was mentioned before, which we have worked with. There is everything about trying to get these countries on teaching them or transferring knowledge in terms of technical knowledge, geological knowledge, training knowledge, everything that goes along with it. And just to make it, to finalize, and the ways of doing that, it's secondment of technical people, joint development teams, joint operational transfer agreements, joint operating teams, sponsoring technical schools. For example, Angola, you don't have petroleum engineering schools. One of the things that we were discussing there was how can we implement a petroleum engineering course in that very country, right? So to create that capability to bring the industry go forward. I think I'll stop with that.
Can I ask the four of you to think of reasons why this doesn't work? Because it is a recipe that I've known and heard about for probably 25 years. Why isn't it working?
Well, I can start. It's difficult for those countries to have the long-term perspective necessary to implement this sort of policy on a realistic and gradual level as well. Brazil is an example of what happens when you try to be too aggressive after a while with local content policy. Then you start to have bottlenecks on the supply chain, and the project costs start to escalate quite quickly. But we are seeing different countries now that are opening up their upstream oil and gas industry, trying different approaches to, especially to local content and local industry development. And it's not only what I would call frontier countries, like countries in East Africa. Even Mexico, which has had an oil industry for more than 100 years, they are thinking very carefully about how they shape the local content requirements on the new bid round that they're going to launch this year. Because they know that they don't have the full industrial base to actually supply a whole range of different projects in the country. So how they can adjust that is the difficult thing. And for countries that are oil economies, the challenge is to think about that in a long time, not to try to bring that up front and then wreck in the projects as they go along. So.
Yeah, I think even scoping it a little bit wider, when we know the solutions, why is change not happening? Yes. I guess that's this applies to local content. It also applies to wherever. And I think it's fair to say that the world has become a bit complex, and corporations have become the word global. It might sound very fancy and it may sound that you can collect a lot of air miles, but really being global is a complex thing, and organizations have become very complex. And as the gentleman said up there, that the leadership in the companies that used to operate very locally has grown into these complex global animals. And I think that it calls for new leadership abilities. How do you lead in a complex world compared to, because there's so many issues to be confronted with. You could talk about all the issues that you're faced with operating in different countries. And I would say that it really comes down to the leadership that we need more of is based more on values, on behaviors. That's going to shape who we are as individuals, who we are as companies, and how we get there as society going forward. And I think that the question we need to be asking ourselves, do we have the leadership in place who are ready to lead in a totally different manner and lead the change that is going to happen. And I'm looking at this crowd, and I can see we have at least 20% women here, at least, which is good. and we don't wear ties. I think that was a point that was made earlier today. But I think it's important when you go out there that you don't become copycats of the past, but that you actually bring some new leadership agility into taking the lead and leading the change that's needed.
I want a reaction to that.
Deal.
You maybe this one. What are you going to do to change the world? And I have seen not much progress. How are you going to fix it?
Well, firstly, my name is Ryan Pereira, and I'm here today working for Gaffney Klein & Associates. So I'm glad that I still look young enough to be an MBA student. So I've actually worked for ExxonMobil and Centrica, and I'd like to reflect on that point about change. So one of the things I've been thinking about, I was speaking to some Canadians recently, and I'm a football fan. But actually, he put it quite nicely, and he said Wayne Gretzky, who's a famous ice hockey player, said, "There's no use skating to where the puck is, skate to where the puck is going to be." And in that context, I've reflected on quite a few things here today. First of which I'd reflect on is the oil price. So 6 months ago, I attended an event which there's a Saudi oil minister, and he was one of the leaders in setting the oil price in the world, arguably. And in that room, there was a number of industry experts where the price was floating around $110 per barrel. And the point was, nobody in that room could have predicted what the oil price was going to be from 4 months now. So to that point, I'd say that we speak about the industry running for 100 years, developments taking place. I think it's a very short-termism view to talk about projects. It has to be looked at. But obviously, a lot of the projects that are taking the FID and are actually going to be invested in are, that 5-10 year time horizon. To the point of skating to where the puck is, I think I've heard a lot from the service people's side of things today, FMC and the other side as well. And I think it's interesting because I get the impression that they're actually way more forward-looking in terms of the technologies that might be required, the innovation that's required. Whereas what we're seeing now for a lot of the oil and gas operators is a lot of the short-termism stuff. And I think one of the points that was mentioned earlier, to elaborate on that, was the fact that there are these two levels of oil prices. So there's the one that we all hear about in the media and that we speculate about, the $80 and where that might fall to. And then there's the real cost at which internal companies actually are evaluating those projects. And again, that needs to be a longer-term view. Now, where that longer-term view lies, I won't claim to know exactly where that's going to be, but my point there is, again, it's skating to where the puck's going to be, and that relates to some of these developments in the new basins, the new national oil companies, because who knows whether, in my area of gas and LNG, whether that's going to be East Africa, whether it's going to be North America, whether it's going to be continued growth in the Middle East. The one point there is, I'd say, to address your question earlier about how the new national oil companies can actually address this, is actually to dare to be different. So learn from what's happened in the past, but also dare to be different in going forward, because they've got a lot to bring to the table.
Thank you. Thank you very much indeed for your attention. I shall draw this to a close, and thank you very much for your contribution.